You have $1,000 to invest. Last year, Metro Coffee made $100 million in profit with an EPS of $1 and trades at $17 per share, which gives it a PE ratio of 17. Daily Brew made just $10 million with an EPS of $2 and trades at $48 per share, which gives us a PE ratio of 24. Which one should you choose to invest in? Most people would pick Metro Coffee because it has a lower PE ratio, but that could be a huge mistake. Many investors get this wrong and leave thousands on the table. This is exactly why savvy investors also use the price to earnings to growth ratio. Hi, I am Nick, a long-time value investor and financial educator. By the end of this video, you'll know exactly how to use the PEG ratio to avoid costly mistakes like this one. At first glance, Metro Coffee looks like the obvious winner. You are paying 17 times earnings versus 24 times earnings for Daily Brew. It seems cheaper, right? But here's the problem with PE ratios. They are a snapshot. They tell you what you are paying today for last year's earnings, but they tell you nothing about tomorrow. Let me show you what I mean. Let's look at the next year's expected profits. Daily Brew's profits are expected to rise to $14 million next year, a massive 40% rise, and continue to do so for the next 3 years. Metro Coffee's profits are expected to grow to $105 million, a 5% rise, and keep rising slowly for the foreseeable future, since Metro Coffee is now a mature business. The static PE ratio doesn't account for this crucial future growth. The higher price tag for Daily Brew might actually make perfect sense once you factor in the company's powerful momentum and far greater expected profit increase. You are simply paying more for a stock that is moving forward much faster. This is where the PEG ratio comes in. PEG stands for price to earnings to growth ratio, and it does something brilliant. It adjusts the PE ratio for the company's growth rate. Here is the formula. PEG ratio is equal to PE ratio over earnings growth rate. Now, if you are not familiar with the PE ratio, pause right here. I've got a dedicated video breaking it down step by step. Link is in the description and in the cards above. PEG only makes sense when you understand PE first, so watch that if you need to. Let's calculate PEG ratio for both companies. Metro Coffee, PE of 17 over 5% growth equals 3.4. Daily Brew, PE of 24 over 40% growth equals PEG of 0.6. Now we see the complete picture. Even though Daily Brew has a higher PE ratio, it has a much lower PEG ratio. You are actually paying less per unit of growth with Daily Brew than with Metro Coffee. As a general rule, a PEG ratio below 1 suggests a stock might be undervalued, while a PEG above 2 suggests it might be overvalued. Daily Brew at 0.6 looks attractive. Metro Coffee at 3.4. You are overpaying for slow growth. Think about it. You could pay $17 for every dollar of earnings from a company growing 5% per year, or $24 for every dollar of earnings from one growing 40% per year. Which is actually the bargain? The numbers don't lie. So going back to our original question, where should you put that $1,000? The PEG ratio suggests that Daily Brew is the better value, even though it looked more expensive at first glance. Now here is something very important. Just like PE ratios, PEG ratios work best when you are comparing companies in the same industry. A PEG of 2 might be expensive for a retail stock, but cheap for a tech stock. That's why, for our next example, we are looking at 2 real companies in the same industry to see PEG ratio in practice. We will compare Ford to Tesla. Ford's PE for 2024 profits is 9, while Tesla's PE for 2024 profits is 215. Now we need to find the expected growth rates for these companies. There are 3 ways we can do it. First, we can use historical earnings growth. how fast earnings have grown over the past 3 to 5 years. The advantage? It is based on actual performance. The downside? Past performance doesn't guarantee future results. Second, analyst forecasts. Growth estimates from professional analysts who build detailed financial models. The benefit? Expert opinions that factor in future expectations. The drawback? Analysts can be overly optimistic or pessimistic. Third, we can use company guidance. This is when management tells investors what they expect earnings growth to look like going forward. It is valuable because management knows the business better than anyone. However, companies sometimes provide conservative guidance to beat expectations later, or they might be overly optimistic to keep shareholders happy. For simplicity, let's use analyst forecasts. Ford is expected to grow earnings by about 14% for the next 5 years. Tesla is expected to grow earnings by around 33% for the next 5 years. Now let's calculate the PEG ratio for both companies using these growth estimates. Ford PE of 9 over 14% growth equals 0.64. Tesla PE of 215 over 33% growth equals 6.52. Even with Tesla's impressive 33% growth, its PEG ratio is still much higher than Ford's. It tells us that despite the excitement around Tesla, you are paying a very high price for each unit of growth. Ford, on the other hand, looks much more reasonably valued relative to its expected earnings growth. This perfectly illustrates the power of the PEG ratio. It doesn't just look at what you are paying today, it adjusts for future growth, giving you a clearer picture of value. One quick note, you can find PEG ratios already calculated on different websites, but here is the catch, they calculate them differently. Some use historical growth, others use future projections, some use reported earnings, others use adjusted earnings. So when comparing companies, always get your PEG ratios from the same source, or you are comparing apples to oranges. Here is the key takeaway. A low PE alone doesn't make a stock a bargain. You have to ask, am I paying a fair price for the growth I am getting? That's exactly what the PEG ratio helps you figure out. But what happens when you compare Ford to a similar company like General Motors? Now we have a problem. General Motors' PEG ratio is also around 0.65. Which stock gives you better value? Both are cheap relative to their growth. This is the exact moment where the PEG ratio falls short for a value investor. But there is another factor savvy investors consider: dividends. General Motors offers a dividend yield of about 1%, while Ford's dividend yield is around 4.5%. That's a significant difference. If you are an income-focused investor, Ford suddenly looks much more attractive. You are getting similar growth potential but with over 4 times the dividend income. But as we just saw with Ford and General Motors, the PEG ratio alone doesn't tell the full story when companies pay dividends. To get the real picture, we need a way to factor dividend yield into the equation. That's where the PEGY ratio comes in. And that's exactly what we are covering in the next video. I am going to show you the exact metric the legendary investor Peter Lynch used to generate 29% annual returns and make millions at Fidelity, and how you can use it to find companies that offer the complete package: reasonable valuation, solid growth, and shareholder returns through dividends. So click on the card here to watch that video next.